Okay, so you want to own a shopping mall. Walk through one on a Saturday afternoon, and it still looks like a machine built to print money. Foot traffic everywhere. A food court running at full capacity. Storefronts stacked wall to wall, each one paying rent on space that costs more per square foot than almost any other retail format in America. Buy the land, build the box, sign the anchors. The tenants basically fill themselves in after that, right? Here's the question that scene never answers. Simon Property Group, the country's largest mall operator, is worth tens of billions of dollars. So why did Washington Prime Group, a REIT spun off from Simon itself in 2014, operating 102 malls and 52 million square feet of retail space, file for Chapter 11 bankruptcy in June of 2021, carrying $3.5 billion in debt against $4 billion in assets? And why, 4 years after supposedly emerging from that bankruptcy, did the company announce in 2025 that it was winding down entirely, selling off its remaining portfolio and laying off its headquarters staff? The foot traffic isn't lying to you, but it isn't telling you the whole story either. A mall isn't really a retail business. It's a leasing and real estate business that happens to have stores inside it. And understanding that distinction is the only way to understand how three major mall REITs filed for bankruptcy within months of each other, and why one of them has now filed twice. Start with what you're actually buying into, because a shopping mall spans a range most people never think through. At the small end, a neighborhood strip center, a modest retail plaza with a handful of tenants, no enclosed common area, no anchor department stores, runs $370 to $580 a square foot to construct, meaning even a compact 30,000 square foot center can cost $11 to $17 million once land and site work are included. This is the entry point most first-time developers actually work with, since it requires nowhere near the capital or the anchor-tenant relationships a full mall demands. Step up to a full enclosed regional mall, the kind with 2 levels, 3 department store anchors, and a common food court. And a typical 250,000 square foot development runs around $75 million all in, before a single inline tenant has signed a lease. And at the institutional end, where the real REITs live, portfolios span dozens of properties and tens of millions of square feet, financed almost entirely through commercial mortgage debt, refinanced every 5 to 10 years against the property's appraised value. A structure that works exceptionally well when appraisals keep climbing, and becomes a genuine existential threat the moment they don't. The mechanism that makes any of these tiers work is something the industry calls anchor economics, and it's the single most important idea in this business. Large department stores, the anchors, are offered rent far below market rate, sometimes almost nominal, because their entire job isn't to generate rent income directly. It's to generate foot traffic. That traffic is then sold at a significant markup to the smaller inline stores, the boutiques, the phone cases, the food court vendors, who pay considerably more per square foot precisely because the anchor next door is pulling in the customers they can't afford to attract on their own. It's a genuinely clever piece of retail engineering when it works. The anchor essentially functions as free advertising the mall owner pays the anchor to accept, rather than the other way around, and the inline tenants happily pay a premium for proximity to that advertising. The entire financial architecture of a shopping mall, top to bottom, is built on the assumption that the anchor stores stay open, stay strong, and keep pulling in exactly the volume of customers the inline leases were priced around. Here's the insider term that explains why this model is so fragile: the co-tenancy clause. Written into most inline tenant leases, a co-tenancy clause allows a smaller tenant to pay reduced rent, or in some cases, break their lease entirely if a specified anchor store closes or if overall mall occupancy drops below a certain threshold. It sounds like a reasonable protection for small tenants signing a long-term lease next to a much larger, more powerful neighbor. In practice, it means a single anchor bankruptcy doesn't just remove one big box from the property. It can simultaneously trigger rent reductions or lease exits across dozens of smaller tenants at once, turning one closure into a cascading revenue collapse that happens in weeks, not years. That's exactly the mechanism that hit the mall industry hardest. When JCPenney, Neiman Marcus, and Lord & Taylor all filed for bankruptcy within roughly a year of each other, it wasn't just 3 anchor stores going dark. It was every co-tenancy clause tied to those anchors activating across hundreds of malls simultaneously, at the exact moment landlords could least afford it, with occupancy and cash flow already under pandemic-era pressure from every other direction at once. The second hidden cost sits in what it takes to refill a vacancy once it happens. When Washington Prime lost a tenant, backfilling that space required offering new tenants far larger upfront allowances than a simple lease renewal would have. Across a recent multi-year stretch, the company averaged roughly $34 a square foot in tenant improvement allowances on new leases, against average starting base rents of only about $24 a square foot, meaning the upfront cash outlay to re-tenant a single vacant space exceeded a full year's rent from that space by nearly 30% before the new tenant had paid a single month of rent back. Which brings us to Washington Prime Group. Spun off from Simon Property Group, the industry's giant, in 2014, the company built a portfolio of mid-tier regional malls across the country. Properties like Scottsdale Quarter in Arizona and Polaris Fashion Place in Ohio, 52 million square feet in total. When the pandemic hit, mandated closures and collapsing foot traffic pushed the company into a debt spiral it couldn't escape, offering tenants rent forbearance that alone cost the company $24 million in lost 2020 revenue, trying to keep those same tenants from going bankrupt and triggering the co-tenancy dominoes described a moment ago. By June of 2021, Washington Prime was carrying $3.5 billion in total debt against roughly $4 billion in assets and filed Chapter 11, joining 2 other major mall REITs, CBL Properties and Pennsylvania Real Estate Investment Trust, both of which had filed within days of each other the previous November. Washington Prime emerged from bankruptcy in 2021 and spent the following years trying to stabilize, drawing on a $100 million loan just to keep the malls operating through the reorganization process. It didn't work. By April of 2025, with major loans maturing and refinancing conditions severely constrained for mall-backed debt across the entire sector, the company announced it was selling off its remaining shopping centers entirely and laying off 139 employees at its Ohio headquarters in 2 phases, winding down the business completely, nearly 4 years after the bankruptcy that was supposed to fix it. The pattern repeated elsewhere in the sector too. Pennsylvania Real Estate Investment Trust, after struggling to turn around its own mall portfolio following its first 2020 bankruptcy, filed for Chapter 11 a second time in December of 2023. National shopping center vacancy climbed to 5.8% by the second quarter of 2025, its highest level in years, driven by the same wave of chain store closures and e-commerce pressure that never really stopped after the pandemic ended. The malls themselves weren't the problem. The debt structure sitting on top of leases that could evaporate overnight, tied to anchors that could collapse in a single filing, was. Not every operator in this sector ended up the same way, and this is the part worth paying attention to. CBL Properties, which also filed for bankruptcy in November of 2020, emerged 12 months later and doubled down deliberately on mid-tier, enclosed malls in stable, growing middle markets, rather than chasing the luxury end of the industry the way some competitors did. By 2025, CBL was profitable enough to be acquiring, not selling, picking up 4 enclosed regional malls from Washington Prime's collapsing portfolio for $178.9 million, part of a broader strategy of redeploying capital from underperforming assets into properties with real, durable cash flow. CBL sold off more than $241 million in non-core malls and open-air centers across 2024 and into 2025, reinvesting the proceeds into the assets that had actually proven they could hold occupancy through a downturn. Same industry, same pandemic, same structural risks. The difference was how much debt sat on top of the real estate when the bad years arrived, and how disciplined the company was about which properties to keep. So how does a mall actually make money, mechanically? Revenue equals base rent per square foot times leasable area, plus percentage rent on tenant sales above a negotiated threshold, plus common area maintenance charges passed through to tenants, minus debt service, minus the tenant allowances required to keep occupancy up. A regional mall's financial health is often measured through funds from operations per square foot, essentially cash flow relative to the size of the property. At Washington Prime, that number fell by nearly 40% over a 5-year stretch, from roughly $6 a square foot down to under $4, even as the portfolio's overall square footage stayed relatively stable. The mall wasn't necessarily getting physically smaller. It was generating dramatically less cash per square foot it already had, the exact kind of quiet decay that looks fine from the parking lot right up until the refinancing comes due. In the optimistic scenario, you've kept anchor tenants stable, negotiated co-tenancy clauses that don't cascade too aggressively, and financed the property conservatively enough that a maturing loan doesn't arrive at the worst possible moment in the leasing cycle. CBL's post-bankruptcy strategy is proof that this version of the business still works, even in a sector under real structural pressure. In the realistic scenario, one anchor bankruptcy triggers co-tenancy clauses across a dozen smaller leases at once. Backfilling those vacancies costs more in upfront allowances than a year of the rent they replace. And a loan signed at low rates comes up for refinancing exactly when lenders have gotten far more cautious about mall real estate as an asset class. Vacancy climbs a percentage point or two, which doesn't sound dramatic in a quarterly earnings call, but it's exactly the kind of quiet erosion that shows up as 40% less cash flow per square foot 5 years later. And by then, there's rarely a single event left to point to. None of it looks like a single dramatic failure. It looks like Washington Prime's 5 years of numbers, quietly worse every single year, until there simply wasn't enough cash flow left to service the debt, and no lender left willing to bet on a refinancing. So if you're thinking about owning a shopping mall, the foot traffic on a Saturday afternoon was never the real business. The real business was always whether the leases underneath that traffic could survive the day one anchor decided to leave.